From car loans to home loans to business loans. Both consumers and businesses that cater to them largely depend on financing. Financing depends on rates. Rates, of course, depend on the Fed. Brian Stutland, we're depending on you to help us hedge here.
Yeah, well, lots of going ons because when you look at it, retail numbers weak. PPI number came in a little lower than expected, although still expanding. And so traders really expected actually rates to maybe go lower off of these last couple of numbers, and they really didn't. The 10-year was actually up 5 or 6 basis points throughout the day today. It seems to sort of been in this uptrend where rates have come down below that 3.5% mark, but now we're sort of at the top end of that trend of moving up in the recent last few weeks here. And so it feels like maybe the 10-year note is stalling out. And with commodity prices recently moving up, we look at oil, like I mentioned earlier in the show, now the Fed may have to start to pivot and continue their rate rise despite what some of their advisors are warning about a recession. And so can the 10-year rate really continue in terms of be bought up, rates lower, people buy that bond for it to go higher? So IEF tracks the 7 to 10-year notes basically on treasuries. And as the rates come down, that IEF will move higher. And I want to be a call seller here. When you look at IEF, right, it's kind of stalled out right here at $100. Come back down. I'd be willing to just take a bet, take in some premium. If I'm long bonds somewhere in my portfolio on a long duration, or I own 10-year notes and whatnot, I'd be willing to sell a call here, sell the May 99 strike for $1.20. When you think about it, in just a few weeks, you collect 1.25%, a little more than that, of premium on the call you sold. Yes, you'd have to be willing to get short IEF above 99. The break even, though, 100.2 is really the break even on this point. And I use this sort of call sell to overlay against any of my long bond duration. I think this is a nice play because I think we're going to sort of stall out here on the 10-year, being able to get significantly lower unless we get some serious recession indications. I don't think that would come until the back half of this year. We're not really in that environment, and that's why I'm sticking with the short-dated option and playing it in May.
Do rates look like they're stabilizing to you?
Yeah, I'm in the lower rates camp. So again, maybe as discussed earlier, so we're basically at the same level we were in the summer a year ago. And one could say it's not about where you were compared to where you were, and now it's the rate of change and where you're headed. The truth is this: the consensus was that rates would be at a 10-year at 5%. We're going to be high fours. We're not. And all the charts that I'm looking at would suggest that rates ultimately are going lower. And I think you want to be long TLT. I'm on the other side of this, or the IEF.
Mike, what about you?
So obviously on April 28th, we're going to get some important data in the form of the PCE, which is the Fed's favored measure of inflation. The goal here, of course, for the Fed was really to get to neutral. That is to say that they would at least not have negative real rates. I think we're very, very close to that. And my sense is that if we get any continuing weak economic data, and I think we're likely going to see some of that, I just don't see the Fed getting aggressive. I kind of expect a pause at the very least coming out of them the next time around, because I have a feeling that the data is going to at least permit them to do that. And if they do, then there is a chance, I think, that rates could actually come in a bit. And I think that would be consistent with the economic picture, and it would be consistent with what the Fed has stated.
Wait, you think they're going to pause in May? The market is like heavily in the quarter point camp right now.
Yeah, I know. And of course, that's a little bit of a contrarian bet. But, my view is that, look, they're going to be very hard about inflation because Powell does not want to be Arthur Burns. He'd rather be Paul Volcker if he has to look at his legacy on the, underneath the painting in the Fed of his portrait. But the fact of the matter is that if we have significantly weakening economic data, it is going to give them an excuse to pause. And I have a feeling that they might be under significant pressure to take that.
I don't know. I think inflation is still too high for comfort. But
I agree it is too high, but it is a question of reaching neutral. So it is not simply an issue of where the rate policy is going to land is such that you don't have negative real interest rates. And if they feel like they can make that claim, and if they feel that it is still trending in the right direction, and they see weak economic data, it wouldn't surprise me to see them pause. And a 25 basis point hike, for what it's worth, ain't much in the grand scheme of things.
Right.